Stop losses are for losers. That's right, I said it. And if you're using stop losses in your trading, well, you're probably losing money. So let's break down the why. Most people are taught when they're new into the financial markets and trading, whether it be stocks, options, or futures, use a protective stop loss. Do you think, really, professional traders, the big guys and girls trading millions, billions of dollars say, oh no, the share price fell, I'm going to use a protective stop loss and get out the position? No, not at all. You're taught that in trading books, on YouTube, on webinars, because it is a safety disclaimer. What do you mean by that? Well, let's say you're trading with a $2,000 account and you use a stop loss. You can limit your losses so you're not blown up and lose all your money. And let's be honest, most new traders, or beginner traders I should say, are using a small amount of money to get started. Professionals have capital, they have buying power. Heck, most are on even margin, and they're trading size to where if the stock goes against them, they can just add more. There's no, oh no, it hit my protective stop loss and the stock bounced back. Not at all. That happens when it becomes amateurs, beginners, people with small accounts who are taught the wrong things to start off. So if you're using a stop loss, and let's say you bought a stock at $10 and it goes down to $9 and you get stopped out, then the stock rallies to $11 later in the day, well, it's because these stop losses are computerized via the algorithms. So therefore, algos will pick off where people have their sell stops, and it will drive price down there and quickly reverse to tag those orders. We're not dealing with the stock market of the 1970s or 80s. We're dealing with highly sophisticated software that, especially when it comes to penny stocks, these stop losses can really harm you. I'll give you an example. If you are trading the options market, which I normally do, and you're buying cheap, outdated, short-term options, let's say for under $1, then using a stop loss on, let's say, 50%, well, that option can move 50% in a day. Hence, why you're buying a cheap out-the-money option, so you get the big percentage gain, or loss, of course, for your buck. If you're trading, let's say, expensive options, a $10 option, and it gets cut in half to $5, well, okay, a stop loss must and can be justified because, well, that's a big expensive option. But if you're using cheap options and let's say trying to get 25 or 30%, that can happen intraday, even on a slight move in the underlying stock. You do have, when you're trading options, very sensitive moves in correlation to the underlying stock price. So please be aware of that. The one thing that I can tell you, what I like to do, and going forward, maybe try this in your trading if you want, is scaling down size. Therefore, let's say you buy that cheap $1 option in a stock and it goes against you, let's say down to 50 cents or 50% loss. Instead of panicking and saying, well, let me get my $50 back per contract, I really need it, try writing it out. And you will see just how the option fluctuates from maybe it goes higher, maybe it goes lower from that stop loss. And if you're still right and have conviction on the direction of your trade, well, then why would you want to exit the position before expiration anyways? If anything, the best strategy that I've done recently has been adding to options as they go down, because then when I get that aggressive move in the right direction in a stock, which is what you want when trading directional short-term options, I can reap the rewards. So to summarize this video, if you're using stop losses in trading, scale down size. I know, guys, it's an ego thing, but start trading smaller. If you do, you probably won't be so scared of the position and the stock going against you to where you have to use a stop loss. And if you are trading a little bit more size and have a little bit more wiggle room, what you can do is always buy more expensive options, buy longer dated positions, or if you're a degenerate and you're trading penny stocks, just stick to the trend. Maybe use a trend line if the stock goes against you, or a moving average, or a mental stop. So if it does go against you, you say, hey, I got enough buying power to move on to the next position. Futures, Forex, I don't touch that. most of you guys who do that or try to get people into that, well, let's just be honest. It's smoke and mirrors. I'm Lance Ippolito. Leave a comment, like, subscribe, and we'll be doing more videos like this going forward. I'm out.